2026. Ladies and gentlemen, we are about to move on and talk about the next topic. So let's stay on schedule and talk about the price of trust and how credit shapes the global economy. Well, in global finance, trust is not abstract, it is institutionalized. Credit ratings that shape borrowing costs, influence sovereign credibility, and guide institutional capital across borders. Now, at a time when global markets are now recalibrating, risk and government is now navigating when it comes to the fiscal pressures, and also credit assessment that becomes a strategic lever. Now, especially when we talk about for emerging economies, the stability of macro fundamentals and the continuity of reform and the predictability of policy influence works on how market price long-term commitments. Rating agencies today evaluate not only economic growth, but also institutional resilience, governance strength, and also policy durability. So let's take this moment and invite our next guest on stage. Welcome Mr. Yann Le Pallec, who is the president of the S&P Global Ratings and the chair of the CRISIL board. Thank you very much, Mr. Pallec, for taking out your time and speaking to us on this very stage of Global Business Summit. Ladies and gentlemen, please give him a loud round of applause.
Thank you very much. Thank you very much. Good morning, everyone. What a tough act to follow, speaking after the minister, but I'll do my best. So, ladies and gentlemen, esteemed guests, thank you for having me at this year's Global Business Summit. So my name is Yann Le Pallec. I'm the president of S&P Global Ratings and the chair of the board of CRISIL. It's both a privilege and an honor to address this distinguished audience of industry leaders, policymakers, and global innovators today. I would also like to extend my sincere appreciation to the Times Group for hosting this incredibly important forum. The topic I will discuss with you, as indicated, is the price of trust, how credit shapes the global economy. Perhaps a good starting point is to focus on the word trust. How do we value trust? And for that, I'd like to take everyone through a brief history session. Last November, S&P Global unveiled its new medium-term strategy grounded in our new mission, advancing essential intelligence. Essential intelligence is rooted in S&P Global's 160-year history. Through our leading benchmarks, data, and workflow tools, we've built a legacy of trust through quality, transparency, and innovation. In 1860, our founder, Henry Varnum Poor, wrote the book to help investors understand the emerging railroad industry in the United States. In 1915, Poor's Publishing issued its first credit rating and later merged with Standard Statistics, establishing Standard & Poor's. At the time, the goal of credit ratings was to provide investors with independent and reliable assessments of credit risk, a basic concept that still stands today. And by standardizing the rating system, investors were given a common baseline for evaluating credit risk and making informed investment decisions. Fast forward to the 1930s, the US entered the Great Depression, and the need for credit rating agencies to gauge the creditworthiness of issuers increased significantly. And the expansion of credit rating services to multiple sectors during this time helped build transparency during a crucial period of economic upheaval. Simply put, investors found trust in the transparency provided by credit ratings. As global markets evolved over the last century, so did the need for trusted and relevant insights. More recently, and a bit closer to home, in 1987, the Credit Rating Information Services of India Limited, or CRISIL, was established with the objective of analyzing, rating, and evaluating securities and instruments such as loans and debt in the local India market. What began as a business alliance in 1996 with S&P flourished into a strategic partnership now 2 decades in the making. Through S&P Global's storied history, we believe transparency, analytical rigor, and integrity have been and will continue to be the foundation of global capital markets and commerce, foundational to building trust. Trust is at the core of credit markets. As a rating agency, S&P performs its role in the financial markets by rating promises to pay back debt in time and in full. When we consider the price of trust and how credit shapes the global economy, I will share three driving thoughts with you all. First, the breakdown of trust in the previous global order. Second, credit markets as a safeguard against uneconomical policy actions. And third, the role of trust in an emerging asset class like private credit. Starting with the breakdown of trust in the previous global order, and in the global rules that sustained it, all of those will carry longer-term credit implications with risks and opportunities alike, even if markets can sometimes brush off near-term event risk. When we refer to trust and geopolitics, we're not talking about blind trust. We mean trust in the geopolitical status quo, trust in policy predictability, and in the tacit and explicit rules that govern trade, capital, and cross-border cooperation. It is easy to become complacent about the credit impact of geopolitical uncertainty. After all, markets have often appeared to look through recent conflicts with no immediate or durable economic implications. But circumstances may differ next time, and in any case, the shift toward a more multipolar world creates inevitable longer-term credit consequences. When trust weakens, policymakers face sharper trade-offs between strategic autonomy, financial soundness, and economic development. If trust is scarce, strategic autonomy often dominates, sometimes at an economic or credit cost, even when such policies are justified. Corporate investors or governments usually respond in two broad ways, either by reducing gross exposures, diversifying away from or exiting certain relationships, each with real cost, or reducing net exposures, hedging, insuring, or demanding more collateral, often increasing the cost of capital and friction in the system. This is not inherently negative. As a credit analyst at heart, I learned early the risks of concentration and the benefits of diversification. Crucially, trust is not merely declining, it is evolving. Declining trust in some relationships increases the incentive to build trust elsewhere. And we can already see that dynamic in global trade. Trade continues to prosper, but it constantly evolves. And it was evolving well before the events of the past 12 months. Over time, we may see global capital markets and capital flows move in a similar direction, though likely more gradually. When trust is fragile, diversification becomes vital. Diversity in thought, diversity in society, and diversification in capital exposure. According to the latest Edelman Trust Barometer, people are narrowing their world to smaller, familiar circles that reflect their views, and this hinders economic and societal progress. In prior years, people put their trust in media, governments, or businesses. Now, this trust is shifted to insularity, lacking the critical element of fact-checking and a broadened perspective. Staying with capital markets, the promising rise in local capital markets adds an important layer of resilience and diversification. For India, for example, a useful anchor data point here is its domestic bond market showing gradual deepening through foreign index inclusions and growing private credit. Foreign ownership of Indian government bonds stood at about 0.9% in 2023, rising modestly post-JP Morgan index inclusion in June 2024. That wider index inclusion could increase foreign participation in India's government bond market to 10% from 0.9% in 2024, and that this would enable funds available for corporate debt issuers in India to almost triple relative to nominal GDP by 2030. The global center of gravity continues to shift. This evolving distribution of trust aligns with a broader structural shift in the global economy. The center of gravity of global GDP continues to move east. According to the IMF, India and China's combined share of global GDP is expected to almost double from shy of 12% in 2010 to 22% in 2030. Emerging markets are expected to represent roughly 2/3 of global growth this year. And this trend has been supported by improved domestic policy predictability and transparency in several markets at a time when global uncertainties are rising. These shifts carry two notable long-term credit implications. First, supply chains, tariffs, and resilience. Growth costs now, insurance value later. The reorganization of supply chains and the increased use of tariffs and industrial policy are likely weighing on economic growth and profitability, particularly for established players. In the near term, some of those pressures may be masked by tailwinds such as the AI and data center investment boom. But this shakeup can also create opportunities for emerging players. And while building resilience can have an upfront cost, it can also be understood as a form of long-term insurance paid for calmer periods, valued in more volatile ones. Second, regulatory cooperation may become more fractious. This may not present as an immediate problem. Today, we still benefit from a long period of regulatory tightening and strengthened frameworks. But when market stress hits, timely, decisive, and coordinated policy responses can be essential. And that uncertainty extends to new global regulatory challenges, including emerging areas such as decentralized finance and private markets. So moving on now to closer to home, India. To close, I really want to bring this conversation back to where we are. Last August, S&P Global upgraded India's sovereign credit rating to BBB from BBB-. That upgrade didn't happen by chance. It reflected a sustained commitment to fiscal discipline, targeted public investment, and credible policy frameworks that have enhanced confidence in the country's long-term growth trajectory. India's post-pandemic expansion has been among the most consistent of any major economy, and our expectations remain strong for the medium term, driven by structural reforms, entrepreneurial energy, and a forward-looking approach to debt and development. In our latest report from S&P Global's and India Research chapter, produced in collaboration with CRISIL, we explored how India is navigating a new global reality. What we found was a story of resilience, but also one of ambition, which is at the core of Viksit Bharat 2047. Of a nation shaping the future by building trust at home and on the global stage. And that brings us full circle, because in the end, if trust is the currency of credit, then transparency is the institution that preserves its value. When trust rises, capital flows. And when it breaks down, the cost of capital becomes a tax on progress. In that sense, the price of trust truly is the price of growth, and few economies understand that better than India. Thank you very much for your attention.